Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. Go. Hi. Today my guest is J.Mintzmyer, and he's a lead researcher at the Value Investors Edge. I think he's also a founder of that research service. It's mostly focused or entirely focused, maybe Jay can correct me on that, on the shipping sector. And he and his team are super knowledgeable in this space and like about all the companies that are in the like closely adjacent industries. And that's very valuable because there are a lot of moving parts here. And I'm just really excited to see what we can learn from him today. Jay, welcome.
Hey, thank you so much for having me here, Bram. You know, I've been a fan of yours on Seeking Alpha for many years as well. I remember back in several years ago when you had a lot more hair going on too. So it's great to circle back and chat with you today.
Thanks. Yeah, it's since I have a few kids and the hair disappeared real fast. Well, let's see. So I think everybody who's like an avid reader of Seeking Alpha, and many will be tuning in, they probably know you and they don't need an introduction because you're like a top 5 service over there. But maybe for the listeners that view this video and who are not on Seeking Alpha, maybe you can tell us how you got interested in investing and especially why you love shipping so much.
Of course. Yeah. Thanks, Bram. So yeah, I started investing in the late 2000s, a little bit younger. So I had my first brokerage account actually in 2008. So that was kind of a fun introduction to the markets and seeing how those things went down. I think one of my first trades or stocks was Ford when it was deeply sold off, and I was betting on a recovery there. So, you know, I had the...
So you were a value investor.
I had the deep value investor right out of the get-go, and you know, I had sort of that beginner's luck, if you will, of getting fortunate on that one. Sold way too early, of course. You know, I think I bought for like, I don't know, $250, and then I bought some more when it hit like $2, and then I dumped it all at like $4 or $4.50. And I think I don't remember exactly, but I think Ford went on to go like 13, 14 bucks or something. So, you know, let that one go too early. But that was my introduction to the markets, right? And you know, Seeking Alpha at the time was, I hadn't even really heard of it, but it was kind of like a small blog community site. It wasn't really popular or anything. But I started reading blogs about different stocks I was looking at or trading or starting to invest in. And I did that for several years. And then I think it was around 2011 was when the site became a little bit more professionalized. And at that point, I decided, hey, I'm going to become part of this. I'm going to do a couple blogs, nothing serious, but I want some feedback and I want to, you know, meet some folks. And that's how I got started. So, I mean, wow, that's like 9 years ago now. And, you know, I fell into shipping because I am just fascinated. I'm an economics undergrad and a public policy, international relations master's. I'm actually working towards my doctorate right now in international relations. And I am fascinated by trade and all those dynamics. And at the same time, shipping stocks were very cheap. They're very sold off because that was after the big 2008 collapse. And so in 2008, all these ships, they overbuilt and there's too much credit, too much debt, and there's just bankruptcies left and right. And there's all these little like zombie companies. And it was just a very interesting space. There was a bunch of companies that were dirt cheap and very attractive. And there was a couple that were just absolute disasters that made for good shorts. So yeah, that a little bit lengthy, but that was my introduction. And 5 years ago, I started a research service, and here we are today.
Cool. And you know, shipping is like, I think it's super fun industry, but it's a bit unusual space. It's really small. The companies that are in there, they have small market caps, and it's like extremely global. And it's one of the reasons that you like it so much. But it's also concentrated in just a few countries. Maybe Greek and Norway are pretty big, and there are like a few like shady characters and people that don't know what they're doing. They're losing a lot of money from time to time. Like in my country, it's really popular. When shipping is doing really well, people get these mailers with, where they sold the bonds for like 8% return or something. And well, you know how that ends. And it's forever in the trenches. the industry, it seems. And then it's raining gold. Yeah, I'm just on everybody who owns as much a rowboat. How do you see the shipping space from a high level, and how are you trying to get like an edge here?
Yeah, absolutely. It's kind of the Wild West still of stocks in a way. It's like it's somewhat comparable, I think, to like junior miners, like gold miners and iron ore and stuff like that. And
Yeah,
of course,
reminds me of that too.
iron ore is all big boys now, but it used to be a little bit more fringe and biotech and that kind of stuff. And shipping fits itself in there in a weird sort of way, right? It's a very mature industry. Its core, 90% of the world's trade moves on the water. But a lot of these publicly listed shipping companies got off to a really, really rough start in the 2000s. The 2000s, of course, was a big hot market with China joining the WTO in 2001. Global trade soared throughout the 2000s. China's trade with the United States in particular soared. And that was a good market for shipping, right? And China was buying all the copper and iron and coal and everything they could get their hands on. So rates were booming. And, whenever you have sort of a bubble environment, that sort of brings out the I got to choose my words carefully, but that brings out the folks that will try to take advantage. And we had some of that in the late 2000s. There's a few IPOs that, in my opinion, should never have happened. They would never happen in this market. In fact, there hasn't been a mainstream shipping IPO since June of 2015. It has been over 5 years since a major shipping company completed an initial public offering. So that's where we are today. I mean, the industry has completely turned itself from like sort of like a huckster Wild West in the late 2000s to actually very strong corporate governance at many of the names we cover today. So a big turnaround. However, to get to your point about cash flows, it is a cyclical commodity stock, right? So like when times are good, times are great, right? I mean, we're raining in cash flows, but it can turn on a dime and you can be burning cash the next day. So like crude tankers this year, and I'm sure we'll go into that later in our discussion, but crude tankers, perfect example, right? I mean, boom and bust several times within just 6 months.
Yeah, and it's I mean, we've seen like rates of like almost 300,000 like earlier this year, but where they're now like 10,000 or 15. It's just it is amazing. And how are you looking at like the underlying demand that's in the market right now, because it changed so much?
Yeah, the demand really, see in shipping, there's kind of a misconception broadly that shipping is all one big monolith, right? But shipping is actually 6 or 7 or even 8, depending on how you slice it, subsectors. And each one has their own unique supply and demand. I mean, I know you know that, but a lot of the listeners, may not. So when you compare something like dry bulk, which is iron ore, coal, forestry products, that's a completely different supply and
Yeah,
demand
so
from,
I think
say,
that's
crude tankers.
really, how would you like segment it in how would you do that?
Yeah, so the main shipping that I think a lot of folks in the United States think about is container shipping, which is retail goods, right, on those 20-foot or 40-foot boxes. So that's all the stuff you see in Amazon, Walmart, Target. That's all containerized goods. I think that's what most people associate because they see it on the trucks and they see it on the railroads, and that's where the 90% figure comes from. I mean, 90% of that stuff is done by water, which is just phenomenal when you think about how proliferated we see trucks and we see trains, but 90% of it is the stuff you never see, right? The cross ocean ships. So that's one category, and that's one that we're really excited about right now. Another one would be dry bulk, which I just kind of reviewed earlier. The next one would be crude tankers, which is oil, and we talked about that a little bit, the boom and bust. Another one would be product tankers, which is like gasoline, diesel, jet fuel. Another one would be LNG, liquefied natural gas. So that's a very exciting long-term secular growth story as well. And then also, almost like a sister category to that is LPG, which is liquefied petroleum gas, which is basically propane, and that is a booming trade as well. And then that's the main 6. And then there's a couple other little sub segments like offshore and offshore support, oil exploration. There's even like some new like ESG green stuff, like a wind turbine installation vessel is like actually a thing now. But that's kind of the broad layout.
Cool. And so, well, you know a lot about all these different segments, and do you like tilt your portfolio towards like I think LPG is going to be booming, or I think VLCCs are going to do well, or are you just diversified across, or how do you approach that?
So, I tend to have my hands in a lot of different pots at the same time. So I do have exposure across pretty much all the shipping subsegments. However, yes, absolutely. If there's something that we feel is both attractive long term for the growth story and also is not favored by the market, then we're going to have a lot heavier allocation into that. So, for example, last summer, crude tankers were like our number one position to be in, and we were doing well. I mean, we were up nicely in 2019, and then the Costco sanctions happened. And so then all of a sudden it was like paradise, and we were raining in cash flows. And then we were heavy crude tankers throughout that. And then we had this recent floating storage thing. So crude tankers would be one of the more recent ones. And I think if you wanted, we're doing this interview, I don't know when it's going to be posted, but it's 1 October today. It's about 10:30 in the morning Eastern time, and I'll update disclosures right as we go through this if they're relevant. But one of the segments I really like today, and is one of our heaviest exposures, is container shipping. So I'm sure we'll maybe talk about that later. But yes, you're right. We definitely shift our focus between industries based on the prospects.
Cool. And just one question about container shipping. Is that like the segment that can like boom the most? Because at some point, like oil tankers, it gets kind of sensitive. At some point, you don't want to transport it anymore. But containers is almost no ceiling, or
Yeah, I
is
think
that
well, I think
wrong?
with container ships, you don't have a lot of the negative implications that you do. You're totally right, because with crude oil tankers, we don't know when the peak is going to be. I've always been kind of a 2030 kind of guy. I think the peak oil is probably around 2030, but my guess is as good as anybody else's. But the way I look at it, yeah, 2030 probably for oil, 2040-ish maybe for products, maybe 2050 for LNG. These are broad round numbers, right? I mean, don't hold me to them, but that's kind of how I see things. And you're right, there's a ceiling and there's a timeline. With container goods, yeah, I mean, I hopefully things get more efficient in the future. Hopefully emissions come down. But with container shipping, it's going to be mostly about the technology on the vessel, the propulsion technology, right? If we shift away from, right now we use bunker fuel, which is like the really nasty, sludgy stuff. Maybe we switch away from that and go to LNG. Maybe we switch away and go to hydrogen or ammonia. That is where the ESG comes in. Nobody's
Right.
saying like ban containerized goods. I mean, nobody's saying like go back to the Stone Ages, but people are saying maybe we should stop coal trade, right? So
Right. Yeah. That gets me to like my next question, which I'm so interested how you think about like the outlook for shipping, because when I read about it, there's like IMO 2020, and most people that are a little bit interested in shipping, they know about that, and there are new regulations. They have an impact on the market, and what I'm hearing is that CEOs of shipping companies are still really unsure of how they're going to compose their fleets. And yeah, I'm just curious, how do you see that impacting the market, and how you maybe you see a lot of new regulations or other stuff that impacts that?
yeah, absolutely. I mean, we're, October 2020 just started Q4 this morning, and we are in the midst of the biggest regulatory change in, I mean, basically modern shipping history, which was IMO 2020, which was the reduction in the amount of sulfur you could burn. I just mentioned that, heavy fuel oil, bunker fuel is pretty nasty stuff. If you live in a port city, unfortunately, unless you're in the United States where they have a lot of, economic or environmental control areas, if you live in a port city in like Manila or something, like, this is nasty stuff. So they reduced the amount of sulfur emissions from 3.5% down to 0.5. So a pretty huge decrease in the amount of sulfur that was emitted. But that is just, and that was the biggest regulatory shift in decades, if not ever, in modern shipping history. But what I'm getting to is like that isn't even like a baby step compared to the sort of regulations that we could see in the future if we try to tackle climate change. And there's already some efforts on that right now. In fact, about a month ago, there is a European initiative that proposed some sort of like almost like a cap and trade type structure with CO2 emissions. And what that's going to do is it's going to drive up the spread between what modern ships, so ships built in 2015 and newer, can earn versus the older ships. And that's because the older ships are less efficient. So if you imagine some sort of tax at like, I don't know, $100 per ton of bunker fuel, suddenly that daily consumption really, really starts to matter. So that was kind of what IMO 2020 started to do, but just imagine that times 5. And that's the sort of impacts we could have. We call it, sometimes we say IMO 2030, and that's just something we kind of say. But when we say that, it's not actually a proposal or anything. But when we as investors say like IMO 2030, and usually with quotes, we're just referring to all the potential regulations that can happen. So the way we're positioning ourselves is we're trying to pick companies that have strong corporate governance, companies that have access to capital markets, and companies that have modern tonnage and are able to exploit that. Doesn't mean we won't buy older stuff, but we need a big discount to go there.
Sure. Okay, that sounds pretty sensible. And yeah, so the European regulation is interesting because already like newer vessels command a premium. So and you see that widening. So that's cool. And you're most bullish on container shipping. Is there a space that you don't like at the moment or would avoid?
Yeah, it all depends on timelines because, for example, yes, I'm very bullish right now on container ships. I think there's a dislocation there, and maybe we can go into that in a future question because I think I can talk a few minutes on that. But to answer a question I don't like, really right now, I'm not a fan of the medium to long-term prospects in dry bulk. Dry bulk is all coal, iron ore. Iron ore is a pretty strong trade. There's a lot of stuff opening up in Brazil and China, but coal is a rapidly declining trade. And I see that declining. I mean, you can't mathematically have an exponential decline, but a very massive decline between now and say 2030. By 2030, 2040, that trade could be almost dead. Grains are not growing very fast. Forestry products are not growing very fast. Iron ore is a temporary boom. Coal is dying. So yeah, I don't like that sector medium to long term. Maybe for a few months. There's actually a really fun spike going on right now that we're looking at in the Capesize rates, but that's a seasonal type thing. So yeah, so I like the containers. I don't like the dry bulk.
Okay. Yeah, I think coal definitely has big headwinds, even if it's not, that people want to consume less coal. It's because the mines are getting located in less advantageous locations. I think I'd love to talk to you about the container lessors because I've seen some articles from you about those. I thought that you had a really interesting thesis on those. Yeah, I think like Global Ship Lease is an example, right?
Yeah, Global Ship Lease was one I highlighted. I actually did a shipping series on Seeking Alpha. I think it was like mid-August. I can't remember the exact date, but I said, shipping stocks are really beat up in 2020, even though cash flows are strong, because there's like this general perception, and common sense is usually right. I mean, common sense is common for a reason, but sometimes it oversimplifies things. And sort of common sense was like during a global pandemic, shipping isn't going to be a good place to be. I mean, that's common sense. But in fact, as you know, shipping rates have been great in crude oil tankers and product tankers, in LPG, VLGCs, and container rates have been excellent. So there's this disconnect. And GSL was part of that series focused on container ships. Now, in terms of the dislocation, I also put out another article about a week ago today that pointed out some of this. And I'm going to pull up, since we're on the internet here, and one of the advantages of virtual stuff is I can actually pull up stuff on my screen. So let me pull up real quick as we're talking. What I'm looking at here is a chart of every stock that involves container shipping. So I'm looking at a chart. It includes some liner stocks. It includes the ship lessors, which are the companies that own ships and lease them out like equipment. And I'm looking at box lessors.
Are you showing it right now?
I don't think I can share the screen with you, but I'm just saying this is what I'm referencing. So for folks listening to YouTube, this is what I pulled up and this is what I'm looking at, because I'm going to read you numbers that I'm looking at today. And this is even after pounding the table. Look, I mean, I pounded the table 2 weeks ago on Costa Mare, CMRE, which I have long exposure to today. I pounded the table on that thing at $5. Danaos Corp, DAC, which I'm long for disclosure. I bought that at 505. Look, the CMRE is 638 today as I'm looking at it. Danaos is 768. I mean, these stocks are up 25% since I mentioned them. And still, they barely even move the needle to their 52-week trading ranges. So real quick, if we look at the liner companies, one of the stocks that's US listed is Matson. That's MATX. No position in Matson, but their 52-week trading range is $23 to $43. That's kind of the range. They're trading at $40 right now today. So they're basically right underneath 52-week highs, within like 5%, right? Then we have some of the box lessors. One of them is CAI. Uh, one of them is Triton, TRTN, and one of them is Textainer, TGH. No position on any of these three box lessors. But what these guys do is they buy those 20-foot metal containers or 40-foot metal containers, and they lease them out like equipment leasing. It's a very simple, very boring. I mean, it's a metal box that they're leasing out, right? These guys, all three of them, are right near 52-week highs as I'm looking at them. I think Triton is having a little bit of a rough day today. I think they're down like 6% or something, but all three of those are right at 52-week highs. Not only 52-week highs, 5-year highs, almost all three of those stocks. So I'm winding it up here, but then you look at the ship lessors, which are things like you mentioned, Global Ship Lease, which I am long for disclosure, Costa Mare, which I have a long exposure position into. Let's see, what other companies? Danalis Corp, DAC, I'm long that company. I'm basically long everything in box. Let's make the disclosure simple. I'm long the whole thing, right? I'm long every single company except for like one. Every single one of those is at the lower half or even the lower third of their 52-week trading range. It's just like this huge disconnect. And I think it's because these ship lessors, which get lumped into shipping. Remember I told you like everything gets like misconstrued? I think the box
that's what
lessors
I like so much about this idea.
Yeah, the box lessors are so boring that everybody understands that this is purely financial, right? So they're so boring that everybody gets it, right? The liners are logistics. So think FedEx, think UPS. Those stocks, multi-year high. They're killing it this year, right? You think about all the Amazon packages going out, right? So those stocks are crushing it. Unfortunately, all the companies that actually own the ships are shipping, and shipping is bad. So therefore, you have all these companies that are trading in the gutter when they should be hitting, if not 52-week highs, like multi-year highs right now. The market is booming. Rates are stronger than we've seen them in over 5 years in the mid-size segments, but the market just totally disconnected to it.
Cool. Yeah, I thought it was very interesting thesis that I haven't seen before. And yeah, I would also love to hear your thoughts on some on LPG stock, maybe Dorian, because you've
Sure.
written about that as well.
Yeah, Dorian's been a favorite. I've been long Dorian a long time. My position expands when the stock is cheap, and I sell it off if it shoots up. Last year we were long Dorian, I think from like $5 or $6, unbelievable value, and it ended up topping out at like $15. I wish I could tell you I bought it all at 6 and sold it all at 15. I didn't have that luck. I think I sold a few at like $11 or something, and then I held the rest. But great stock, a good U.S. listing, U.S. management. It's not shady or it doesn't have any of those like weird sort of nefarious affiliations or anything like that. They own modern.
People from the company, right?
Say that again. Sorry.
You interviewed like the CEO or?
That's right. Yeah, I spoke with the CFO. His name's Ted Young. He's stationed here in the United States. And I spoke with their COO, their Chief Operating Officer. I think they have a different title for him, but he's the Chief Operating Officer, John Lycoris, who manages all the ships and does that stuff. I've spoken with them several times. In fact, I spoke with Ted just a couple weeks ago. I'll just check in like, hey, how are things going? Are you realizing these rates? I'm telling him, look, these are the index rates that I'm seeing. I'm seeing that you guys are making 40,000 to 45,000 a day for 3 months straight. Like, is this true? And absolutely it's true. And yeah, if you look at the stock, the stock does not reflect this. These are very, very strong rates. Dorian, I don't know where it trades today. I don't want to distract and pull up the chart, but I think it's like $8. The net asset value of Dorian, like if Dorian just sold all their ships and closed down shop and liquidated operations, they don't want to do that obviously, but if they did, the net asset value is more than $20 a share. It trades at 8. Their financial leverage, 30% roughly debt to assets, like very low leverage. Everything about this company is in good shape. They have over $4 in cash, just free cash, unrestricted on the balance sheet. The stock trades at 8. I mean, it's just unbelievable, Ram, and it's shipping. And 2020 has been a frustrating year, Bram, for shipping.
Oh, sure, but those, I mean, that's I mean, you must be used to it. That's part of that industry. It's I love there are like books about the tycoons in shipping, and it's all these billionaires from Norway or whatever, and they go through cycles. It's it's insane, and it's also what makes it a lot of fun. I think if you learn to time it or whatever.
Yeah,
Maybe
certainly.
one last question about LPG. It's how do you think? My impression is it's like a good fuel that's well positioned for the future. Do you agree? Do you think that adds some longevity to that industry, or um,
Yeah, we talked a little bit about how, and these again, rough numbers, broad
yeah,
approximations, like how many people have called peak oil and been wrong for like a century now, right? But oil, if you think of oil as like a 2030, and I don't care if you 2025 or 2032 or whatever, but 2030, right? And then say products are around the 2040 sometime, right? As EVs overtake ICE vehicles, right? And internal combustion engines go kind of the way of the dinosaur, and we're all driving Teslas, one day, right? Being facetious, but yeah, that's kind of the trend, right? Um, LNG and LPG are basically kind of like sister fuels. And I see those as having tailwinds to 2050, 2060, somewhere in there. And because right now there's such a large percentage of the world's power generation that is done by coal. And that has to go away. If you're going to do anything serious, I mean, serious global efforts like Paris Accords type stuff on climate change, you have to get rid of coal. There's no way around it. And part two of that is there's no way around getting rid of coal without massively ramping up natural gas thermal generations. Now, as far as LPG, that's more of a cooking and a heating fuel. So that's used a lot more in countries like India, where sad to say, in parts of rural India, people still cook with like peat moss and animal dung and random scraps of wood they find in the nearby areas. So, I mean, this is a place that most Americans and Europeans can't really understand that. But LPG is a massive growth market in places like India, in places like China, and I think Pakistan is another country where there's a lot of good growth. So that growth is not going to slow down anytime soon. We're barely scratching the surface in some of these markets.
yeah. I think it's an enormous improvement in your standard of living if you get access to these kind of fuels. If you're coming from that situation, maybe we can do one last idea if you have time. You're also interested in Euronav, which is kind of a poster child for the VLCC sector.
Yeah, so Euronav is part of the crude tanker sector, which had inordinate profits throughout the last 3 quarters. So we'll say the ones that have been reported. So Q4 of 19, Q1 of 20, and Q2 of 20. So the 3 quarters that have been reported. Those 3 quarters alone generated about 3 years, maybe 4 years worth of normalized cash flows. So, I mean, we're talking about just an amazing tailwind we're riding with Euronav. Unfortunately, the stock market doesn't love it. It's shipping, it's crude oil. We're
So
talking
we're
about these
currently
20.
or
Yeah, we're talking about, even I'm saying, like 2030, there's a timeline here. But Euronav has, I think of all the companies I follow, and I cover about 55, 56 companies that I follow. And I think of all those 56 companies, I would say Euronav is probably the best managed company in terms of corporate governance, in terms of capital allocation. They've paid significant dividends this year. They have a low leverage on the balance sheet. They've done repurchases. This is just a solid all-around company. In shipping, I don't like to use the words buy and hold and shipping in the same sentence, but if there was like maybe one or two companies where I would say, yes, this is a buy and hold, it would be a company like Euronav.
cool. I think they paid out like 80% of cash flows as dividend or something. And they have a
That's right, of earnings,
policy,
yeah.
something along those lines. Um, well, I think we've gone through all these sectors. I'm kind of wanted to wrap it up a little bit early because you have to be somewhere. Do you have anything last that you want to tell the listeners about the sector, or we pretty much covered it?
Yeah, I think we covered most of it, Bram, and I
Yeah.
appreciate you taking the time to put this together. I would encourage
Uh,
folks, if you're interested in shipping, if you're just a trader that's interested in it, it's very exciting, and just be careful, right? Don't over allocate. As an investor in shipping, if you want to have a longer term time horizon, you really need to do a lot of reading and due diligence and so on. You don't necessarily need to subscribe to a service like mine. I would like it if you did, and I think you would probably like it as well, and hopefully your returns would improve. But whether or not you choose a service like mine, or you do your own due diligence, just know that this isn't a sector where you can just go out there and like pick up a company here and pick up a company there, because you really need to look into who is the management team, what are the incentive structures, how is the share capital set up, what are the loan maturities. There's just a lot of landmines in a sector like this. So I want to caution people.
Yeah,
I like shipping. I love container ships. I'm long, literally, basically all of them. But just be cautious and do your own research before you dive in.
yeah, there's often a lot of debt involved, and that causes a lot of volatility, which can go both ways. Where can people find you or reach you, or yeah, what's the best way?
So in terms of the premium research and the articles I put out as well, you can go to Seeking Alpha and search for J.Mintzmyer. My first name is just the letter J. I get a lot of people asking about that, but you can see me there on Seeking Alpha. In terms of just really quick follow, I'm on Twitter. It's at Mintzmyer. So you'll see my spelling here in the interview. So just jump on Twitter, follow me there. We're rapidly growing on Twitter. And then, of course, for the more in-depth stuff, check out our Seeking Alpha profile.
Okay, well, I'll link to that stuff in Seeking Alpha right up. I'll do, and where I'll post this video. Thank you so much for coming on. Have a very nice day, and thank you very much.
Thank you, Bram.